Hello, friends. Welcome to Mancy's Wisdom. Today we begin the most important chapter of your trading journey. Not indicators, not chart patterns, not option strategies, not secret formulas. If you truly understand today's lesson, it can save you years of frustration and potentially lakhs of rupees in avoidable losses. The lesson is simple. The market rewards recognition. The market does not reward prediction. Let me repeat that. The market rewards recognition. The market does not reward prediction. Yet most beginners spend their entire trading career trying to predict what happens next. They ask, will this stock go up tomorrow? Is this the bottom? Will Nifty reach 30,000? Will this breakout work? Every one of these questions is a prediction, and prediction is where most beginners get trapped. Why? Because prediction feels intelligent. It makes us feel special. We love saying, I knew it before everyone else. But the market is not interested in rewarding fortune tellers. The market rewards evidence. The market rewards patience. The market rewards traders who wait until reality becomes visible. Let's understand this through a simple example. Imagine you are standing beside a busy road. A prediction trader looks at an approaching car and says, I think that car will stop. Without confirmation, he starts crossing. Maybe he reaches safely, maybe he gets hit. His success depends on guessing correctly. Now imagine a recognition trader. He waits, he watches, he sees the car slowing down, he sees the brake lights, he sees the traffic signal turning red. Only then does he cross. Notice the difference. One trader guessed, the other trader observed. One trader hoped, the other trader confirmed. Professional traders behave exactly like the second person. Now let's bring this into the stock market. Imagine a stock has been struggling below 100 rupees for several months. Every time it approaches 100 rupees, sellers appear. Most beginners look at 95 rupees and think, this time it will definitely break. So they buy. Then the stock falls to 85 rupees. Suddenly, confidence disappears. Now look at what a professional trader does. The professional waits. The stock moves above 100 rupees. Volume increases sharply. The stock closes strongly above resistance. Now there is evidence. Now there is confirmation. The professional may buy at 102 rupees. Yes, he pays slightly more, but he buys with information. He buys with proof. This is recognition. Many beginners worry about buying slightly higher, but professionals worry more about buying without evidence. Think about that carefully. Would you rather pay a little more for certainty or pay a little less for uncertainty? Now let's discuss one of the most dangerous traps in trading, the falling knife. A stock falls from 500 rupees to 400 rupees, then to 300 rupees, then to 200 rupees. At 300 rupees, the prediction trader says, it cannot fall further. Buys. Stock falls. At 250 rupees, he buys more. At 200 rupees, he buys even more. Soon, he is trapped. Not because the stock was bad, but because he was predicting. Now watch the recognition trader. He waits. He observes. He notices selling pressure reducing. He notices price stabilizing. He notices volume improving. He notices a breakout above recent resistance. Only then does he act. Not because the stock became cheap, but because the market showed strength. The difference may sound small, but it changes everything. One trader buys because he believes. The other trader buys because he sees. Let's use a cricket example. Imagine a batsman standing at the crease. Before the bowler releases the ball, the batsman swings blindly. What happens? Most likely he gets out. Now imagine a professional batsman. He watches the ball leave the hand, he observes the speed, he judges the length, he recognizes the direction, then he plays the shot. Great traders do exactly the same thing. They react to information. They do not react to imagination. So why do beginners love prediction so much? Because prediction is exciting. Prediction feeds the ego. Prediction creates the feeling that we know something others don't. But markets have a brutal way of humbling certainty. Being right too early often feels exactly like being wrong. A stock may eventually do what you predicted, but if it falls 30% first, your account may never survive long enough to benefit. Professionals understand this deeply. They ask different questions. Instead of asking, will it go up? They ask, is it going up right now? Instead of asking, is this the bottom? They ask, has the market shown signs that a bottom may already be forming? Instead of asking, will buyers come? They ask, are buyers already showing up? Do you notice the shift? Prediction looks into the future, recognition looks at reality, and reality is far more profitable. Now let me give you a practical framework. Before buying any stock, look for 3 signs. Sign number 1. Trend. Are higher highs forming? Are higher lows forming? If yes, that is evidence. Sign number 2. Breakout. Has the stock crossed an important resistance level? If yes, that is more evidence. Sign number 3. Volume. Did volume increase during the breakout? If yes, the move gains credibility. When all 3 align, then consider taking action. Not before. Another powerful habit is maintaining a trading journal. Before every trade, ask yourself, am I predicting? Or am I recognizing? If your reason sounds like, I think it will double, you are probably predicting. If your reason sounds like, the stock broke resistance with strong volume and a rising trend, you are recognizing. There is one final tool I want to share. I call it the courtroom test. Imagine you are a judge. A stock walks into your courtroom. Now ask yourself, what evidence would convince me this stock is strong? Would opinions convince you? Would social media posts convince you? Would television anchors convince you? No, only evidence should convince you. Price action, volume, trend, confirmation. If the evidence is weak, the verdict should be simple. Do not trade. For the next 30 days, I want you to try something. Never buy a stock because you think it will rise. Buy only when the trend is visible, the breakout is confirmed, volume supports the move. This one habit alone can eliminate a large percentage of beginner mistakes. And now let's conclude today's episode. The biggest difference between amateurs and professionals is not intelligence. It is not education. It is not access to information. It is mindset. Amateurs try to predict what the market will do. Professionals wait patiently for the market to reveal what it is already doing. Prediction says, I know. Recognition says, show me. And in the market, show me is infinitely more profitable than I know. Thank you for joining me in today's episode of Mancy's Wisdom. In our next chapter, we will explore a powerful concept called the pivotal point, the place where the market is forced to reveal the truth. Until then, protect your capital, trust evidence over opinions, and remember, the market rewards recognition, not prediction.
Hello, friends. Welcome back to Mancy's Wisdom. Today we're going to discuss a concept that can completely change the way you look at charts. A concept so powerful that once you understand it, you'll stop asking one of the most dangerous questions in trading. The question is, what do I think will happen next? And you'll replace it with a far more profitable question. What is the market revealing right now? Today's lesson is called the pivotal point. A pivotal point is not just a price level. It is a truth-telling zone. It is the place where the market is forced to reveal its hand. The place where buyers and sellers can no longer hide. The place where opinions stop and reality begins. Let's understand this with a simple story. Imagine a student who keeps telling everyone, I think I topped the class. I am sure I scored highest. My paper went very well. Maybe not. Those are merely opinions. Then comes result day. Suddenly all the guessing ends. Now the truth is visible. The result day becomes the pivotal point. Before the result, opinions. After the result, facts. The stock market works exactly the same way. Everyday traders argue, bullish, bearish, target 1,000, target 500, but eventually the market reaches a level where the truth must reveal itself. That level is the pivotal point. Now let's look at a real trading example. Suppose a stock has repeatedly failed near ROM 100 for 3 times it touched ROM 100, 3 times it fell. Every trader is watching. Every institution is watching. Every algorithm is watching. Now ROM 100 becomes important. ROM 100 becomes the pivotal point. Now something interesting happens. One day the stock approaches ROM 100 again, and suddenly, volume explodes. Price surges through ROM 100. It closes at ROM 105. The market has spoken. The market is saying, buyers have won. Notice something important. You didn't need to predict. You simply waited for the market to tell you. Now let's imagine the opposite. The stock reaches round 100. Sellers appear aggressively. Price collapses to round 95. Again, the market has spoken. But this time the message is different. The market is saying sellers still control this area. Weakness has been revealed. Again, no prediction was required, only observation. This is why professionals love pivotal points, because pivotal points remove guessing. Now let's move to something every Indian trader understands. Nifty. Imagine Nifty is approaching a major all-time high. News channels become excited. Experts start making forecasts. Social media becomes noisy. Everyone wants to know, will Nifty break out? What happens when Nifty reaches that level? Think about the difference. One question demands prediction. The other demands observation. If Nifty reaches resistance and shows strong volume, broad participation, powerful closing strength, then the market is revealing bullishness. If Nifty reaches resistance and shows heavy selling, weak close, failed breakout, then the market is revealing weakness. The pivotal point becomes the judge, and the market delivers the verdict. Let's use cricket. India needs 6 runs from 1 ball. The entire stadium is nervous. Millions of people are watching. Before the ball is bowled, everyone has opinions. We'll win. We'll lose. We'll lose. It's impossible. It's easy. Then the ball is delivered. 1 moment later, reality is known. That final ball was the pivotal point. The market has similar moments every single week. Support levels, resistance levels, breakouts, breakdowns. These are all moments where the market must reveal the truth. Now let's discuss one of the biggest reasons beginners lose money. Most beginners buy before the pivotal point. Suppose resistance is round 100. The stock is trading at round 98. A beginner says, I know it will break. Not evidence? Now watch what the professional does. The professional says, show me. He waits. The stock breaks round 100, volume increases. The close remains strong. Now he enters. Yes, he paid a slightly higher price, but he bought a much higher probability. And in trading, probability matters far more than getting the lowest price. Now let's explore 3 powerful types of pivotal points. The first is the breakout pivotal point. This is the most common. Imagine a stock trapped below round 100 for months. Every rally fails. Then one day, price explodes through round 100, volume surges. The market reveals strength. Round 100 was the pivotal point. The second is the pullback pivotal point. After a breakout, many stocks return to test the breakout level. Suppose the stock breaks round 100, moves to round 150, then falls back to round 100. Now everyone watches. What happens next? If round 100 holds, strength is confirmed. If round 100 breaks, the breakout may have failed. Again, the market reveals truth. The third type is the climax pivotal point. This is one of the most fascinating. Imagine a stock doubles in 3 months. Television channels are discussing it. Friends are recommending it. WhatsApp groups are celebrating it. Everyone wants to buy. Volume becomes enormous. Then suddenly, the stock stops rising. Something changes. The excitement remains, but the price stops responding. This can become a climax pivotal point. Sometimes it marks the end of a trend. Not always, but often enough that professionals pay close attention. Now I want to share a secret. Most beginners ask, where can I make money? Professionals ask, where will I quickly know if I am wrong? That single question changes everything. Because great trading is not about being right. Great trading is about managing risk. Imagine buying a stock at 102 after it breaks 100. You decide, if price falls below 198, I am wrong. Now your risk is clearly defined. The market has given you a clear line in the sand. That clarity is priceless. Let's make this practical. Every weekend, open your charts. Take a notebook. Mark 5 things: previous highs, previous lows, major support, major resistance, recent breakout levels. These areas become potential pivotal points. Then during the week, don't chase random price movements. Wait for price to approach these important zones. And when it does, become a detective. Ask questions. Is volume increasing? Is the close strong? Is participation broad? Is momentum improving? Let the market reveal the answer. Don't force your own answer onto the market. Before every trade, ask yourself 5 questions. Question 1, where is the pivotal point? Question 2, what must happen there? Question 3, what confirms strength? Question 4, what proves me wrong? Question 5, is the reward worth the risk? If you cannot answer all 5 questions, you probably should not take the trade, because uncertainty is expensive, and clarity is profitable. Now let's close today's lesson with something powerful. Most people think successful traders predict the future. That is one of the biggest myths in finance. The best traders are not fortune tellers. They are observers. They don't force the market to agree with them. They patiently wait for the market to reveal itself. A pivotal point is where opinions end and facts begin. Amateurs guess what will happen. Professionals wait for evidence. Amateurs anticipate. Professionals observe. Amateurs argue with the market. Professionals listen to the market. So the next time you look at a chart, don't ask, "What do I think?" Because the market's opinion is the only opinion that matters. Thank you for joining me on today's episode of Mancy's Wisdom. In our next chapter, we'll explore a fascinating concept called the operator's mirror, where the biggest challenge in trading is not the market, but the person staring back at you in the mirror. Until then, wait for the market to reveal the truth, respect pivotal points, and let evidence guide every decision you make. Hello friends! Welcome back to Mancy's Wisdom. Today we arrive at a chapter that many traders spend years trying to avoid. A chapter that has nothing to do with indicators, nothing to do with chart patterns, nothing to do with moving averages, nothing to do with option chains. And yet, this chapter may have a bigger impact on your trading results than all of those things combined. Today's lesson is called The Operator's Mirror. And before we begin, I want you to imagine something. Imagine two traders, same stock, same chart, same entry, same stop loss, same target. One trader makes money, the other loses money. How is that possible? If the setup was identical, what changed? The answer is simple. The chart was the same. The mind was different. And that is what today's lesson is all about. The most important indicator in trading is not on your screen. It is inside your head. Let's begin with a simple analogy. Imagine a luxury car, perfect engine, perfect tires, perfect brakes, perfect steering, technically flawless. Now imagine the driver is angry, distracted, emotional, frustrated. What happens? The car crashes. Was the problem the car? No. The problem was the driver. Trading works exactly the same way. Many traders spend years improving the car, new indicators, new systems, new strategies, new software, new scanners, but they never improve the driver. And then they wonder why accidents keep happening. The operator's mirror asks a powerful question. Before studying the market, have you studied yourself? Let's talk about the first emotion. Fear. Then pulls back slightly to row 105. Nothing unusual, nothing alarming, but suddenly your mind starts speaking. What if I lose my profit? What if it falls tomorrow? What if this is the top? Fear takes control. You sell. A month later, the stock is trading at row 140. Many beginners think, the market cheated me. No, the market didn't cheat you. Fear did. The operator's mirror would have asked, am I selling because the chart changed, or because I became scared? That one question can save countless profitable trades. Now let's talk about greed. Fear exits too early. Greed exits too late. Imagine you create a perfect trading plan. Buy at RAI 100. Target RAI 120, stop loss RAI 195. The stock reaches RAI 120 exactly. Your plan worked perfectly. But now greed whispers. What if it reaches RAI 150? What if it reaches RAI 100 200? What if this becomes a multi-bagger? You ignore your plan. The stock reverses, falls, and eventually you exit at RAI 105. You had the profit. But greed convinced you that more was never enough. The market wasn't the problem. Greed was. Now let's discuss one of the most dangerous traps in trading. Revenge trading. Suppose you lose RAF 2000 in the morning. You feel frustrated, embarrassed, angry. Instead of accepting the loss, your ego says, get it back. Immediately. Today. Right now. So you take another trade. Loss becomes RAF 4000. Now emotions increase. You increase position size. Loss becomes RAF 8000. Now panic begins. At this point you are no longer trading the market. You are fighting your emotions. And emotions always fight dirty. The market doesn't even know you exist. Yet many traders behave as though the market personally attacked them. The market is not your enemy. Your emotions are. Now let's talk about a silent killer. Boredom. Most beginners underestimate boredom. A quiet market day arrives. No setups. No opportunities. Nothing to do. Professionals remain patient. Beginners become uncomfortable because doing nothing feels unproductive. So they create action. Random trade. Random entry. Random loss. Notice something important. The trade wasn't caused by opportunity. It was caused by boredom. Professionals understand something powerful. Sometimes the best trade is no trade. Now let's discuss ego, perhaps the most dangerous emotion of all. Imagine buying a stock at RAF 500. The stock falls to RAF 400, then RAF 450, then RAF 430. The market is sending a clear message, but ego refuses to listen. You say, I know I'm right. The market is wrong. It will come back. Immediately. Eventually the stock reaches RAF 350, and suddenly a manageable loss becomes a painful disaster. Professionals don't marry opinions. Professionals marry facts. When facts change, they change. Ego says, I must be right. Wisdom says, I must survive. There is a huge difference. Let's use cricket. Imagine a batsman. First ball, he gets beaten badly. The bowler embarrasses him. Now the batsman becomes angry. Next ball he swings. Hello friends. Today I want to ask you a simple question. When you look at a trade, what is the first thing you think about? Most beginners immediately ask, how much money can I make? But professional traders ask a completely different question. How much money can I lose? That single difference changes everything. Because trading is not a game of making money first. It is a game of staying alive long enough to make money. Imagine building a beautiful house. What do engineers focus on first? Paint? Furniture? Decorations? No, they focus on the foundation. Because if the foundation collapses, nothing else matters. Trading is exactly the same. Risk management is the foundation. Profit is merely the decoration. Without a strong foundation, profits become meaningless. Today we're going to learn why protecting money is more important than making money. Let's imagine two traders. Both begin with RAW1000000. Trader A hears a hot stock tip. His friend says, this stock will double. Without any plan, without any stop loss, without any risk calculation, he invests RAW180,000. The stock falls 25%. Suddenly, his account falls to RAW180,000. Now he faces a painful reality. To recover that loss, he needs a 25% gain just to return to where he started. Now meet Trader B. Same capital, same market, but a completely different mindset. He decides, I will never risk more than 1% on a single trade. His maximum risk is RAW100,000. If he is wrong, he loses RAW100,000, not RAW120,000, not RAW130,000, just RAW100,000. One trader chases profits, the other protects capital, and over time, the second trader usually wins. Many beginners think trading is about making big money quickly. Professionals know trading is about surviving. Imagine two traders again. Trader A wins. RAW5000, RAW8000, RAW4000. Wonderful. Then one bad trade happens. Loss. RAW40000. Months of hard work disappear. Now Trader B wins. RAW2000, RAW500. Losses. RAW1000, RAW800, RAW100 wulls. Losses. RAW1000, RAW800 wulls. 900. His growth seems slower, less exciting, less glamorous. But here's the secret. He survives, and survival creates compounding. The trader who survives gets tomorrow's opportunity. The trader who blows up his account does not. In trading, the first goal is not getting rich. The first goal is staying in the game. Let's use cricket. A T20 team needs 10 runs per over. One batsman becomes impatient. He tries to hit every ball for 6. What happens? Eventually, he loses his wicket. Now another batsman arrives. He rotates strike, protects his wicket, takes singles, occasional boundaries, and keeps scoring. Who helps the team more? The second batsman. In trading, your capital is your wicket. Lose your wicket and the game becomes very difficult. Protect your wicket, and opportunities will keep coming. Remember this forever. Your trading account is not designed to impress people. It is designed to survive markets. Before every trade, ask one powerful question. What will prove me wrong? If you cannot answer this question, you should not enter the trade. Suppose, buy at RAW500, stop loss at RAW480. Now you know exactly what proves you wrong. A fall below RAW480. That clarity is powerful. Most beginners enter first and think later. Professionals think first and enter later. Before pressing the buy button, know where you enter, where you exit, where you admit you are wrong. Because uncertainty destroys accounts, clarity protects them. Let's compare two trades. Trade 1. Entry RA100. Stop loss RAW95. Target RAW115. Risk =sign RAW5. Reward =sign RAW15. Risk-reward ratio =13. Now imagine you're right only 40% of the time. You can still make money. Why? Because winners are much bigger than losers. Now trade 2. Entry RA100. Stop loss RAW95. Target RAW103. Risk =sign RAW5. Reward =sign RAW3. Now you must be correct almost every time. That's very difficult. This reveals an important truth. Success doesn't come from being right often. Success comes from managing losses intelligently. Many traders obsess over winning percentage. Professionals obsess over risk-reward. Now let me share one of the most powerful rules in trading. The 1% rule. Suppose your capital is RAW100,000. Never risk more than 1%. That means maximum loss per trade equals sign ROD 1000. No exceptions, no emotional decisions, no oversized bets. Now calculate position size. If entry equals sign ROD 100, stop loss equals sign ROD 195, risk per share equals sign ROD 15. Maximum risk equals sign ROD 1000, position size equals sign ROD 10005, which equals 200 shares. Simple, logical, professional. This single rule prevents catastrophic losses. It allows mistakes because mistakes are inevitable. Disasters are optional. Let's conclude today's chapter with one of the most important truths in trading. Profits are uncertain. Risk is controllable. You cannot control tomorrow's market. Breaking news. Capital preservation. Most beginners ask, how much can I make? Professionals ask, how much can I safely lose if I'm wrong? Because every trader is wrong sometimes. The difference is that professionals make sure being wrong never becomes fatal. So before your next trade, pause and ask yourself, am I protecting my capital or am I gambling with it? Because in the long run, the market rewards survival first, profit comes later. Thank you for joining me for another episode of Mancy's Wisdom. In the next chapter, we'll discover why volume validates price action and how smart money leaves clues hidden inside volume. Until then, protect your capital, respect risk, and remember, a trader who survives can always trade tomorrow. Hello, friends. Today I want to ask you a simple question. When you look at a trade, what is the first thing you think about? Most beginners immediately ask, how much money can I make? But professional traders ask a completely different question. How much money can I lose? That single difference changes everything. Because trading is not a game of making money first. It is a game of staying alive long enough to make money. Imagine building a beautiful house. What do engineers focus on first? Paint? Furniture? Decorations? No, they focus on the foundation. Because if the foundation collapses, nothing else matters. Trading is exactly the same. Risk management is the foundation. Profit is merely the decoration. Without a strong foundation, profits become meaningless. Today we're going to learn why protecting money is more important than making money. Let's imagine two traders. Both begin with rupees 1 lakhs. Trader A hears a hot stock tip. His friend says, this stock will double. Without any plan, without any stop loss, without any risk calculation, he invests rupees 80,000. The stock falls 25%. Suddenly, rupees 20,000 disappears. His account falls to rupees 80,000. Now he faces a painful reality. To recover that loss, he needs a 25% gain just to return to where he started. Now meet Trader B, same capital, same market, but a completely different mindset. He decides, I will never risk more than 1% on a single trade. His maximum risk is rupees 1,000. If he is wrong, he loses rupees 1,000, not rupees 20,000, not rupees 30,000, just rupees 1,000. One trader chases profits, the other protects capital, and over time, the second trader usually wins. Many beginners think trading is about making big money quickly. Professionals know trading is about surviving. Imagine two traders again. Trader A wins, rupees 5,000, rupees 8,000, rupees 4,000. Wonderful. Then one bad trade happens. Loss, rupees 40,000. Months of hard work disappear. Now Trader B wins, rupees 2,000, rupees 3,000, rupees 1,500. Losses, rupees 1,000, rupees 800, rupees 900. His growth seems slower, less exciting, less glamorous, but here's the secret. He survives. And survival creates compounding. The trader who survives gets tomorrow's opportunity. The trader who blows up his account does not. In trading, the first goal is not getting rich. The first goal is staying in the game. Let's use cricket. A 2020 team needs 10 runs per over. One batsman becomes impatient. He tries to hit every ball for 6. What happens? Eventually, he loses his wicket. Now another batsman arrives. He rotates strike, protects his wicket, takes singles, occasional boundaries, and keeps scoring. Who helps the team more? The second batsman. In trading, your capital is your wicket. Lose your wicket, and the game becomes very difficult. Protect your wicket, and opportunities will keep coming. Remember this forever. Your trading account is not designed to impress people. It is designed to survive markets. Before every trade, ask one powerful question. What will prove me wrong? If you cannot answer this question, you should not enter the trade. Suppose, buy at rupees 500, stop loss at rupees 480. Now you know exactly what proves you wrong. A fall below rupees 480. That clarity is powerful. Most beginners enter first and think later. Professionals think first and enter later. Before pressing the buy button, know where you enter, where you exit, where you admit you are wrong. Because uncertainty destroys accounts, clarity protects them. Let's compare two trades. Trade 1. Entry Rs 100. Stop loss Rs 95. Target Rs 115. Risk equals Rs 5. Reward equals Rs 15. Risk-reward ratio equals 1 to 3. Now imagine you're right only 40% of the time. You can still make money. Why? Because winners are much bigger than losers. Now trade 2. Entry Rs 100. Stop loss Rs 95. Target Rs 103. Risk equals Rs 5. Reward equals Rs 3. Now you must be correct almost every time. That's very difficult. This reveals an important truth. Success doesn't come from being right often. Success comes from managing losses intelligently. Many traders obsess over winning percentage. Professionals obsess over risk-reward. Now let me share one of the most powerful rules in trading, the 1% rule. Suppose your capital is Rs 1 lakh. Never risk more than 1%. That means maximum loss per trade equals Rs 1,000. No exceptions, no emotional decisions, no oversized bets. Now calculate position size. If entry equals Rs 100, stop loss equals Rs 95, risk per share equals Rs 5, maximum risk equals Rs 1,000, position size equals Rs 1,000 divided by Rs 5, which equals 200 shares. Simple, logical, professional. This single rule prevents catastrophic losses. It allows mistakes, because mistakes are inevitable. Disasters are optional. Let's conclude today's chapter with one of the most important truths in trading. Profits are uncertain. Risk is controllable. You cannot control tomorrow's market, breaking news, global events, unexpected volatility, but you can control position size, stop loss, risk per trade. Capital preservation. Most beginners ask, how much can I make? Professionals ask, how much can I safely lose if I'm wrong? Because every trader is wrong sometimes. The difference is that professionals make sure being wrong never becomes fatal. So before your next trade, pause and ask yourself, am I protecting my capital, or am I gambling with it? Because in the long run, the market rewards survival first. Profit comes later. Thank you for joining me for another episode of Mancy's Wisdom. In the next chapter, we'll discover why volume validates price action and how smart money leaves clues hidden inside volume. Until then, protect your capital, respect risk, and remember, a trader who survives can always trade tomorrow. Hello friends, welcome back on Mancy's Podcast. Imagine standing outside a shopping mall. One shop is completely empty. Another shop is crowded with customers. Which business would you trust more? Most people would choose the crowded shop. Why? Because activity creates confidence. The stock market works exactly the same way. Price tells us what is happening, but volume tells us how much conviction is behind that move. Today we're going to learn a powerful truth. Price may tell the story. Volume tells whether the story is believable. Many traders look only at price. Professionals study both, because volume is the market's heartbeat. And when you learn to read that heartbeat, you begin to see what most traders miss. Let's start with the basics. Volume simply means how many shares changed hands. Suppose stock A rises 5%, but only 100 people traded it. Now suppose stock B rises 5%, but 10 lakh shares were traded. Which move is more trustworthy? Usually the second one, because more participants agree with that move. Think about an election. If one candidate wins with 10 votes, the victory means little. If the same candidate wins with 10 million votes, that victory becomes meaningful. Volume is the market's voting machine. It reveals where attention is flowing, where money is flowing, and often where opportunity is flowing. Now let's discuss one of the strongest signals in trading. Price rising, volume rising. Imagine a stock trading at Rs 500. Suddenly it breaks above resistance. At the same time, volume doubles. They are willing to commit serious money. This is often how institutional investors leave footprints. Large players cannot hide volume. They may hide their identity, but they cannot hide activity. When price and volume rise together, the market is shouting, something important may be happening here. These are the situations professionals pay close attention to. Now let's look at a warning sign. Price rises, volume falls. At first glance, the chart looks bullish. But beneath the surface, something is missing. Participation. Imagine giving a speech. The audience applauds less and less every minute. Would you feel confident? Probably not. The same logic applies to stocks. When price rises but volume keeps shrinking, the move may be running out of fuel. Not every low-volume rally fails, but many weak rallies begin this way. This is why volume acts as a lie detector. It helps us separate genuine strength from temporary excitement. One of the most expensive mistakes traders make is buying every breakout. Not all breakouts are equal. Some succeed, some fail. Volume often reveals the difference. Imagine a stock trapped between rupees 950 and rupees 1000 for months. One day it finally breaks above rupees 1000. Now ask one question. Did volume explode? If volume is 2 or 3 times normal, the breakout deserves attention. If volume remains weak, be careful, because many false breakouts occur when participation is absent. Professional traders love breakouts, but they trust only those supported by strong volume. Volume turns suspicion into confidence. Now let's discuss something many investors learn too late. Distribution. Imagine a stock near its all-time high. Price appears strong. News appears positive. Everyone is excited. But something unusual happens. Volume suddenly becomes enormous. Yet price stops advancing. What could this mean? Sometimes smart money is quietly selling. Retail investors see opportunity. Institutions see an exit. Large volume without meaningful price progress can be a warning signal. It suggests supply may be overwhelming demand. The crowd sees strength. Professionals see distribution. And that difference can save enormous amounts of money. Think of yourself as a detective. Every day the market leaves clues. Price is the headline. Volume is the evidence. Suppose you see a breakout, a reversal, a trend change, a new high. Don't immediately act. Ask, what does volume say? Volume confirms. Volume questions. Volume warns. Volume validates. The best traders don't chase every move. They investigate every move, because the market rewards observation, not excitement. Let's conclude today's chapter with a simple truth. Price attracts attention. Volume reveals conviction. A stock can rise temporarily without volume, but sustainable trends usually require participation. Remember these 4 rules. Price up plus volume up equals strength. Price up plus volume down equals caution. Breakout plus high volume equals confidence. High volume plus no progress equals warning. Never let price speak alone. Always ask volume for a second opinion, because in the stock market the loudest voice isn't always the smartest. But volume often tells you where serious money is moving. Thank you for joining me for another episode of Mancy's Wisdom. In our next chapter, we'll discover how market leaders emerge before the crowd notices them. Until then, follow the trend, protect your capital, watch the volume. And remember, price tells the story, volume reveals the truth. Hello friends, welcome back to Mancy's Wisdom. Today I want to ask you a simple question. When do people usually notice greatness? When an athlete wins a gold medal? When a singer becomes famous? When a company becomes a giant? But here's something interesting. Success doesn't begin on the day the world notices it. Success begins quietly, long before the headlines. The stock market follows exactly the same principle. The biggest winners rarely announce themselves. They whisper first, and only later they make enough noise for everyone to hear. Today's chapter is about learning to hear those whispers, because fortunes are often created before the crowd even realizes something extraordinary is happening. Imagine a beautiful restaurant that nobody knows about. On the first day, only a handful of customers arrive. The food is exceptional. The service is outstanding. Slowly, word spreads. Weeks later, people begin waiting outside for a table. Months later, television channels feature the restaurant. Social media explodes. Everyone suddenly wants to visit. But who received the greatest benefit? The people who discovered it first. The market behaves exactly the same way. By the time television debates begin, by the time newspapers praise the company, by the time everyone starts talking, much of the move may already have happened. The greatest investors don't chase popularity. They recognize leadership before popularity arrives. So what exactly is a market leader? It isn't simply the biggest company. It isn't necessarily the oldest company. A market leader is a stock that consistently demonstrates strength. Its earnings improve, its sales grow, its price outperforms competitors, its industry becomes stronger. Institutional investors quietly accumulate shares, even when the overall market hesitates. True leaders often refuse to fall significantly. Strength attracts strength. Capital flows toward excellence. Professional investors understand this deeply. Weak businesses require hope. Strong businesses create confidence, and confidence attracts money. Here's one of the most powerful observations you can ever make. Watch what happens during market corrections. Suppose the index falls 5%. Some stocks collapse 20%. Others barely move. Now ask yourself, why? Because somebody is supporting them. Professional money often reveals itself through relative strength. The strongest students don't merely pass examinations. They consistently rank near the top. Likewise, market leaders consistently remain among the strongest performers. They recover faster, rise faster, and often begin moving before the broader market improves. Strength is rarely an accident. It is often a clue. Remember our previous chapter about volume? Today, let's connect those ideas. When genuine leaders begin advancing, price often rises with unusually strong volume. That tells us participation is expanding. Institutions cannot secretly buy millions of shares forever. their footprints eventually become visible, and volume becomes one of those footprints. When you see higher highs, healthy corrections, strong earnings, and rising volume, pay attention. The market could be quietly introducing its next leader. Great opportunities rarely knock loudly. Sometimes they simply leave footprints for observant people. Many beginners believe a low-priced stock is automatically a bargain, but price alone tells us nothing about value. A stock trading at 50 rupees can still be expensive. A stock trading at 5,000 rupees can still be cheap. The real question isn't how low is the price. The real question is, how high is the quality? Market leaders often appear expensive. People hesitate. They wait for lower prices. Sometimes those lower prices never arrive. The strongest companies often become stronger. Instead of chasing weakness, learn to recognize excellence. Quality deserves attention, not because it's expensive, but because it consistently delivers results. The market rewards patience far more than excitement. Become an observer. Watch earnings, watch sales growth, watch industry leadership, watch relative strength, watch volume, watch institutional participation, create a watch list, study it daily. You don't have to trade every opportunity. In fact, some of the greatest decisions in investing are the trades you wisely choose not to take. Discipline protects capital, observation creates wisdom, and wisdom creates consistency. Let's conclude today's chapter with one lasting thought. The crowd follows yesterday's winners. Professionals search for tomorrow's leaders. Never let excitement replace research. Never let headlines replace analysis. Never let emotions replace discipline. Train your eyes to recognize strength before popularity. Train your mind to think independently. And train your heart to remain patient. Because in the stock market, the biggest rewards often belong not to those who move the fastest, but to those who see the clearest. Thank you for joining me for another episode of Mancy's Wisdom. In our next chapter, we'll explore another timeless principle that separates successful investors from the crowd. Until then, stay curious, protect your capital, study the leaders, trust evidence over opinions, and remember, the market whispers long before it shouts. Hello, friends. Welcome back to Mancy's Wisdom. Today I want to begin with a question. What is the most valuable asset of a trader? Is it intelligence, experience, secret indicators, or advanced software? No, the answer is much simpler. Your capital. Without capital, there is no second opportunity. Imagine a farmer who eats all his seeds, or a soldier who wastes all his ammunition, or a pilot who starts a journey with almost no fuel. The mission ends before it truly begins. Great traders understand something that beginners often overlook. Capital is not merely money, it is opportunity, it is survival, it is tomorrow's possibility. Protect it and it will continue to serve you. Neglect it, and the market will quickly teach an expensive lesson. Most beginners wake up asking, how much money can I make today? Professionals ask something entirely different. How much money can I safely avoid losing today? That single shift in thinking changes everything. Suppose two traders both earn excellent profits. One took reckless risks. The other protected capital carefully. They may appear equally successful today, but over years, only one is likely to survive. Because successful trading isn't about one brilliant trade, it's about staying alive long enough to benefit from hundreds of good decisions. The market rewards consistency, not occasional heroics. Let's talk about numbers. Imagine losing 50% of your capital. Many people think, I'll simply earn it back. But mathematics says otherwise. A 50% loss requires a 100% gain. Just to break even, lose 70%, and recovery becomes dramatically harder. Large losses don't simply reduce money, they reduce confidence, they reduce flexibility, they reduce future opportunity. Professional traders know something profound. Making money is important, but avoiding devastating losses is even more important. Imagine standing beside a quiet forest. Two hunters enter. One fires at every movement, every shadow, every sound. Soon, his ammunition is gone. The second hunter waits patiently. He observes carefully. He acts only when probability is clearly on his side. Who survives longer? Who succeeds more consistently? The market offers opportunities every week. You don't need every trade. You only need good trades. Patience isn't weakness. Patience is intelligent capital preservation. Sometimes, doing absolutely nothing is the highest quality decision of the day. Many beginners believe more trades mean more profits. Reality often proves the opposite. More trades frequently create more commissions, more emotional decisions, more impulsive mistakes, more unnecessary losses. Imagine a professional's week. Monday, nothing worth trading. Tuesday, still nothing. Wednesday, one outstanding opportunity appears. He takes it. Thursday, he waits again. Friday, still patient. Meanwhile, another trader forces 20 random trades. The professional may have traded once, but often he finishes with better results. Not because he worked harder, because he waited smarter. Every morning before opening your charts, ask yourself one simple question. If this trade fails, can I comfortably accept the loss? Your position sizing is not limiting your profits. It is protecting your future. Professionals think in probabilities, not certainty. Every trade can fail. The objective is simple. Never allow one mistake to become a catastrophe. Here's a challenge that can transform your trading. Start keeping 2 journals. The first records every trade you executed. The second records every trade you wisely avoided. Right? No confirmation, weak volume, poor risk-reward, unclear trend, no pivotal point. At the end of every month, review both journals. You may discover something remarkable. The money you didn't lose was just as valuable as the money you earned. Sometimes your greatest profit comes from staying out of the market. Let's conclude today's chapter with one timeless truth. Markets will always create new opportunities, tomorrow, next week, next month, next year. But your ability to participate depends entirely on preserving today's capital. Never confuse activity with progress. Never confuse excitement with opportunity. Never confuse courage with recklessness. Protect your capital, protect your discipline, protect your peace of mind, because in the end, great traders are not remembered for making spectacular gains. They are remembered for surviving long enough to let disciplined decisions compound into extraordinary success. Thank you for joining me for another episode of Mancy's Wisdom. In our next chapter, we'll continue exploring the timeless principles that separate disciplined professionals from emotional speculators. Until then, stay patient, stay humble, protect your capital, respect risk, and remember, the trader who survives is the trader who eventually thrives.